Let's get started. So first off, I'd like to say thanks for everybody being here today on this Saturday. And we're going to dive into profit through uncertainty, which we're in a lot of uncertainty right now, using kind of a really fantastic low risk, high reward option tactics, the Butterflies and Long Condors. So anyway, so thank you so much for being here. And I love these Saturday events because, the markets are closed. It's kind of hard to focus for me anyway, when the markets are open to kind of go through kind of some, kind of interactive presentations and stuff. I'm always so distracted, but Saturdays are perfect. We can, markets are closed. We don't have to stare at the charts, and we can, today we're going to talk about two really, really unique and amazing option strategies, the Butterfly and the Condor, which are super great for this environment where we have a lot of total uncertainty and headline risk and things like that, where we want to really control our risk. So that's what we're going to dive into today. Kind of first off, a little background on myself. I've been, actively trading now for, got to pinch myself for, 40 years. I started out my trading career back in the 80s at a company called Coastal Corporation, which was a large major oil company with refining and gas and all, everything pretty integrated. But anyway, they were out of Houston, so I was able to get my foot in the door there, got an interview, and got into a program they had for, they'd actually trained me to trade crude oil and products and things like that for the company, which was a great opportunity for me. And so sent me down to one of the refineries they had in Corpus, Texas. Spent about 3.5 months down there, just kind of learning the foundation of oil, which is good to understand things. And the tankers coming in, put it in the refinery, putting out the different products. And so I went through that, and then ended up in the shipping department, chartering tankers, which is really cool. And then finally ended up on the trading desk on the cargo side, foreign cargoes, and sent me out almost, about out of a year I was there. They sent me out to Singapore for a couple of years to trade products and Asian cruise, which was a fantastic experience. If you ever get a chance, make sure you check out Singapore. And then got a job. One of my buddies was over at a company called Transworld Oil, and he got me into that company, which was just an amazing company. At that point in time, they were the largest oil trading company in the world. It was Transworld, Fibro, and Mark Rich. So got in with that group, and then ended up in their corporate office in Bermuda for 16 years. Ran the international trading desk out of Bermuda for over 10. But that's where we started trading options. I remember we started trading options back in 1987. We started selling option, premium on cargoes of crude. So the Wall Street guys would come in, they were teaching us, okay, you got to start using options. And at that time, we didn't have really, any, we had to set up our own option models and all that stuff. So that's where I started in 87 on options, kind of never looked back. So it's a great way to trade. So I love trading with direction, and then, incorporating options to, for your defined risk. So that's what we're going to talk about today. So the following presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. So, like I said, I've been trading now for options for over 30 years. And what I found that the most valuable go-to option strategies that really can help literally any trader or investor more than any other strategy known, and especially when we get an extreme market uncertainty like we are now, are the option Butterfly and the Long Condor. So I kind of call them my, trading secret weapon. So you'll go through and you'll see why. Now, the huge advantage that these strategies have is their unique option framework. It's designed to take advantage of time decay and volatility. And those are the two main option pricing components. So this can be used in any market environment, but it really makes it my favorite kind of go-to strategy when we're in these kind of chaotic markets, because we really want to control our risk, but we still want to have potential to make a really great return on the risk that we're putting up. So it's just about, knowing when and then how to use these two strategies. So because they're structured to require only a small amount of your hard-earned capital, your trading returns are going to be explosive. So it's kind of like lightning in a bottle. So my first boss, I remember he would get so excited when we'd have a great trade. We'd do a really good job on it. And he would say, man, this is like lightning in a bottle. I wish I'd just bottle it up and do this every time. So that's kind of how I feel about some of these trades that you'll get with the option side using butterflies and condors. Now, the butterfly and condor, long condor, they're very dynamic and they can be traded for a variety of different reasons with different goals in mind. So really, in other words, you're going to learn how to trade the butterfly and condor, and then you're going to be covered for both your offense, like your profit, and also defending trades. So goals and protection. So it's a really great, kind of a two-sided type of trade that you get to use in your trading portfolio. Now, these strategies that can work no matter what the market direction is. It could be the market or trade. It could be up, down, or sideways. Going to be, taking the unsettling guesswork out of your trading a lot of times, because you're going to have your trade so defined and your risk so low. It's going to really then also help to eliminate the stress of having to be perfect on your stock's direction or overall market. Now, this will also eliminate your time decay expense that you're going to encounter from decay long options, which I'm sure you're aware of that. It's kind of a painful thing where you have a long option trade and, you're going nowhere. You can see it just kind of going down in value every day. So this is going to eliminate that. They can also be structured for very low cost with low capital at risk, and can offer you returns of 15 to 1 or higher rewards your risk. So we're going to go through and I'll show you some really amazing trades that we put on that are actually, we've made bigger, larger returns than 15 to 1. So really exciting type of trade strategy to understand. Now, the butterfly and long condors, they're also going to be used when you're hedging. So when you mesh your trade up, and we're all going to have some trades that go against us, this can become a fast, really low-cost way that you can cover your what pronto when that position moves against you. And I've literally found no other hedging strategy that even comes close to this as far as incorporating for a hedge. Now, by constructing either a butterfly or a long condor around a strike of a trade that's under pressure from a core trade you have on. So let's say you have on a credit spread or a debit spread, this is really becomes one of the best ways I've found to immediately not only neutralize the risk, but it's going to lower the risk of your initial trade. And this is one of my members, Pam. She said, I wish I'd known how to do this hedging strategy before I lost so much money doing credit spreads. So, if you've done credit spreads, you understand, the situation. You'll have a lot of good trades with small winners, but then you'll have that one that goes through your short strike and it kind of wipes out all your profits. Well, the butterfly strategy is one way that we can hedge, really hedge quickly a credit spread. So we'll talk about that a little bit later. Now, when we look at the structure, it's kind of a simplistic structure to start with. And so here's an example. So this would be like if you're long a call debit spread. So you're long a call and you're long this call at 10.10. This was like on the NASDAQ 100, but you'll just see this is a risk profile of that. So you're long this call here, and then you're short a call above it, at that 10.20 strike. So you can see this is a $10 wide spread. So with options, that would be $1,000 wide. So remember, one option contract is equivalent to 100 shares. So this would be $10 wide. So your spread width is $1,000. Okay. Now your trade here, your debit cost of your call debit spread in this example is 300. So you're basically risking a 300 to make the potential, if it expires at expiration above that, you can make $700. So that's a call debit spread. So pretty nice risk reward. Now, if we wanted to adjust this, or we wanted to reduce this risk, this capital at risk, we could immediately do it quickly by creating a butterfly. So in this example, I could sell a bear call credit spread. Let's sell a call at that 10.20 strike, and then buy a call above it to hedge that. Okay, $10 wide spread, $1,000 wide, and then I'm getting $200 credit. Okay, so that's my credit received. Now, if I did this as an initial just credit spread, this is what we call a probability type trade, but I'll be risking 200, not 200, but I'm risking $800 to make two. Okay, so that's what we call a negative risk ratio. But when I combine the two together, they create a butterfly. Okay, so in this situation, a balanced butterfly. So now I've got my risk reduced from that initial $300 to only $100. Okay. So here, if it goes out the top, we call this the tent. If it goes out the top of the tent, I would make my potential max profit in this example of $900. Okay, so I have that call credit spread. I added I have the call debit spread. I add the credit spread. So I've got this $10 wide spread. My risk now is reduced to 100, and I've got that $10 wide spread. Okay, so my potential return is $900 if it goes out at expiration right there. So these can be tremendous, return type trades that you can put on. That'd be a 900% return. So just think about it. So when you're in a really, high, uncertain, chaotic market, and you really want to tighten that risk, but you still want to have a chance to make a good return, you can kind of see the potential that this butterfly offers. So this is one example. We're going to go through a bunch here today so you can really see how they work. Now, the other, I kind of call this the cousin. This is the long condor, not to be confused with an iron condor. So in this example, instead of, doing the butterfly and having that kind of a tight threading that needle there, we can widen out the spread. So widen out the spread, making a bigger profit zone. So we'd be like, and we can do this with puts or calls for any kind of directional trade. So we're long that call, short the call, but instead of doing the butterfly, we can widen the zone out and have a bigger zone of profit. Now, we've been doing a lot of these lately because this gives you that wider profit zone. And I'll show you a bunch of examples here as we go. But, in the current market, we've been doing a lot of these, for downside moves, put condors and things like that. Now, this is a totally different thing than an iron condor. So if you're, wondering if they're the same, this is what basically distinguishes this. This is, going to be made up if you're doing calls. This spread would be both calls, okay? So you'd have a call debit spread and a call credit spread. If you're doing it with puts, you'd have a put debit spread and a put credit spread. Now, an iron condor is the opposite. So the iron condor, you're going to have two spreads. You would have a, like a bear call credit spread, and then you'd have a bull put credit spread, okay? You can see that. So you're having a call credit spread and a put credit spread, two credit spreads. That's the iron condor. Now, these are much lower in, profit. These are going to be typically an iron condor is a full credit spread. So you're going to make maybe, 30, 40, 50, 60%, whereas long condors, you can make 200, 300, 400% returns on your return, which is super, super low. So it's a really great, unique strategy. Now, the core concept that really, make these two strategies work is kind of what we call, let's just kind of go through it, but the core thing that really is important to understand in both of these strategies comes down to understand how option pricing works. Okay, so when we're looking at option pricing, the concept of really time decay, which is, theta, and implied volatility, these are the two key components that really affect the price of your option. So let's do kind of a quick overview of that so you're, understanding that if you're not sure. Now, when we look at, the theta, with this, which is kind of the core component, that tells us then how much an option price is going to go down over time. So it's going to be the rate of time decay of your stock option. And at expiration, at the end of your option series, this part of the component goes to zero. And that also applies to the implied volatility. So these are the two components that we can really take advantage of when we're doing the butterfly and the long condor. Now, here's a little kind of example to kind of show you the math of it real quick. So if you had a company, let's say XYZ, and it's trading at $45, and you're looking for just a small move down to 43, we can target that 43 directionally and create a really low risk butterfly. So in this example, what I could do is I could go out and I'm looking for a move down to 43. So I could buy that 44 put, the May 44 put. That would cost me in this example $2.38 or $238. Okay, and then I would sell the 43 put, bring in a credit of $1.67, and then I'd sell that again, and then also buy the May 42 put, spending $1.06. So if you see here, this is what we call the body of the butterfly. So it's kind of that targeted area where we're going to be short. So we're short the body and long the wings. So that's why it's called a long butterfly. So long the wings, short the body. So we'd have something like this, a very narrow winged butterfly. Now, if you look at this, then the total risk, we looked at 238 plus $1.06. That's the cost of the debit cost. Bringing in that credit 2 times $1.67, so times 100. So we've got in this total risk of this butterfly $10 for the butterfly spread. If you did 1, that's your risk 10. If you did 10, you've got 100. So very low controlled risk. Now the profit, you just take the middle strike and the lower strike. So you're going to see that's $1. So the $44, $43 wide spread, less your cost of the trade, the debit, okay? And that's going to give you your potential profit. So 43 less 42, that's your spread width of $1, less your cost of the trade, 10 cents. That gives us a profit, so $1 wide spread, less our cost, so potential to make $90 per butterfly spread. So if it goes out there at expiration, we make 90 bucks on our risk of 10. That's a 900% return, or we're risking $1 to make 9. So that's a positive risk ratio versus if you just do credit spreads, you're always going to have that negative risk ratio. And that's what I don't like about credit spreads. But when we combine them, we can do some awesome things. So let's take a look at, how to go about choosing the best butterfly or long condor strategy, to match your trading goals. So, when we're choosing, a trade, in my opinion, one major goal for every trader should be to select trades based on what's going to give you the most consistent positive return with low defined risk and not always that greatest return. So I always tell my members and clients, I like to look at the market. I look at the risk first, and I like to look at, let's hit some singles, some doubles, some singles and doubles, and then to stay in the game. And then eventually we're going to hit that, triple or home run. So you're going to have a smoother equity curve if you're, controlling your risk and hitting singles and doubles rather than going for the big one, all the time. Now, then it comes down to the best way to achieve this, in my opinion, again, is to be aware of the different strategies you have out there, option strategies that are available to you, understand how they work, and then go about selecting the one that's going to be best suited for what market environment you're trading in, and also your specific trading goals. So, everybody here today is going to have a different amount of capital to trade. We might have, Calvin might have $100,000 or $200,000 trading account or bigger, and Bill, might have just a $5,000 or $10,000. So it's going to make a difference as far as your risk profile of, how much you put at risk. Now, the really great thing, though, when you look at the butterfly, specifically also the condor, long condor, is you can trade these with a small account, a retail account like ourselves, like we have, like one contract, or you could be a hedge fund and trade thousands of these contracts. So, I've done those I had a brokerage desk that I set up, and we literally did, I think it was 20,000, butterfly option contracts on oil futures. So you can do one contract or you can do thousands. So amazing strategy, but easy for anybody to learn and use. Now, when we look at this, I kind of call it the butterfly family, and it consists of, the key component again is selling. We're going to be selling time, and volatility is a big part of these two strategies. So when we look at the butterfly, though, there's a lot of different variations. So we can do a butterfly with call. So we could do a call or put butterfly. We can do a variation, what we call a broken wing or skip strike butterfly using calls or puts. We could do what I call a ninja unbalanced or ratio butterfly, both using calls or puts. We can do the iron butterfly. We can do a broken wing ratio butterfly. We can do another cool trade. What we do a lot of times when we see it very selective is a Lotto butterfly. And then we've got a whole nother category, hedging. So defending trades using the butterfly as a trading defense. And then we can use also the long condor. So with the long condor, then we can do ratio condors. We can also learn from your losing trades, what's winning, what's losing, what makes them, what makes them tick, So that's how you really go down and kind of look. I'm kind of a visual learner, so it really helps me to kind of pick things apart to understand how they work. So let me see. Yeah, so this course, what's the question is, what's the difference? Well, I do the course based on kind of the last time I did this course was 6 months ago. So so the markets have totally changed now. So a lot of the trades and the butterflies and the condors have been more, selective for, kind of a bear market. So it's going to be really kind of, kind of shifted to that direction. You're going to see a lot of different variations of butterflies for downside kind of trades and things that are really tightening the risk. So they're always structured for the market environment we're in. So, if you took this course a year ago or 6 months ago, it's going to be a totally different course. Now the principles are the same, but the difference of how you use them is going to be the main difference. So I think you'll get a lot of different stuff out of the course based on where we are now. Just checking here. Yeah, if you've got the course from 2022, I would definitely, jump into this one. You're talking 167, and this will be such a different thing for you. So much more stuff that, I've thrown in there and the different variations. So I definitely would recommend, doing that. One more question here. Yeah, we can question on natural gas. Sure, we can take a look at that. All right. Yeah, and it's 4 months to the alert service, and I'm giving you 5 months to the trading club as a kind of addition there. Okay, so let's take a look at a bunch of these different variations so you can understand. So the first one I'll go over is a very narrow wing butterfly. Yeah, the alert question, are the alerts easy to understand? Yes, they are. I'll show you some examples here on the alerts and what I use to send them out. I use a service called Telegram. And so it's a really fast thing that's sent out, and I'll show you some examples. Question, I thought when I sign up it was free updates for life. I don't give anything for life because I don't know how long I'll be around. So when I do a course, I'm not sure where you got that from. I always do something, totally defined, right? So when I sell something, it's either, now, yeah, correct. When you get a course from me, yeah, it's for life. All this stuff, yeah, good question. Okay, so the question is, do you get it for life? Yeah. So if you buy this butterfly course, it is live, but also recorded. So then it is yours for life. You'll have a login to your members area, and then you can go in and access any of your courses, forever. If you do lose your password or something, then just let us know and we'll get it for you, even if you're not a member. So, anything that you've taken or, bought from me, you'll have it. Yeah, you'll have it for life. So you may have done a swing trading course or an earnings course or, a Fibonacci or, whatever it is. So you'll have your list of everything, and then all the indicators. If you buy any of my indicators, those are yours for life as well. There's no licensing fee. There's nothing that you have to pay. So once you pay, that's it. Boom, you're done. So you have access to it, forever. So, good question. Sorry I didn't clarify that earlier. Okay, so let's take a look now. This is just to kind of the start. This is a narrowing butterfly, and the other great thing is with butterflies or condors, we do a lot of these with ETFs. Okay, a lot with SPY, QQQ, and the Russell. We've been doing those kind of the three. Now, but you can do these on anything. You could do these on futures. You can, like I said, did a 20,000 butterfly, futures deal on a butterfly for oil. So you can do this on anything, but we're, primarily, I like to follow the equities, the, high liquid type stocks, and then the ETFs. So it could be, XLE, it could be, XLF, some of the sectors, or SPY, QQQ. So this is the one that we did, and these trades that I'm going to show you today, these were all, alert type trades that were sent out to members. Now, this one was one back some time ago, but I just wanted to show you this trade because it's a narrowing butterfly. And I like to use Fibonacci, what I call price target mapping, to define my target areas. Now your target, when I look at butterflies, I typically have a target and I make the target, the body of the butterfly at that target. And so the Fibonacci is a great way to do it. So in here, you've got that high to low. Okay, so we've got our Fibonacci levels. And so you can see here, this is a 618 retracement area coming in about 273. So also I like to look at option activity, and there's a lot of option activity at this area, this 273. So this was the body. So we set up a really tight, narrowing, low risk butterfly targeting 273. So this you can see is a spread targeting at 273. The body bought the 272, sold the 273, sold the 273, bought the 274. Dollar wide butterfly. That's it. Your total risk here is 10 bucks. Spread width is $1, less your cost, so potential to make 90 bucks, 900% return. Now, in this trade, you can see here this 10 cents debit, so 10 bucks. Now we actually made $70. What time frame charts I typically use? So these are basically based on swing trades, and so typically a daily time frame. Yeah, if you've taken the course, well, when did you take the course? If it was recently, let me know. When did you take this course? Okay. Yeah, daily time frame. Hold on 1 second. Let me erase this. One second here. Okay. So that's the risk reward profile you are seeing here. Okay. And so 2 days later, this trade, we were out of this trade at about 273. And, you know, it wasn't quite a total, you know, max profit, but it was up $70 on that spread risk of 10. So this was a 700% return. Okay. So, you know, on 4 contracts, that was $280. So that's taking advantage of time decay, volatility collapse, and, you know, a high return on your capital at risk. So the other ones that we do quite a bit of are what we call the wide wing butterfly. And 1 second here, I've got to check something out. Bear with me here. Okay. All right. So yeah, go ahead, Shafi. I sent you that. You can use that. Okay. If you're interested there. Just looking at some questions here. Okay, 1 second here. Yeah, here you can use this, Richard. Retake. Yeah. Let me just plug that in and give it to you. Yeah, thanks for asking. Okay. All right, let's get on with this. 1 second. Any other questions here as I pause here for a bit? Okay, so the wide wing butterfly, these are, you know, ones that we use quite a bit because what it does, it gives you a bigger, fatter, wider profit zone. So think about it, you know, if you're, you know, looking to catch a butterfly, it's going to be much easier probably to use a really big wide net, right, than a small butterfly net. So when we do a wide wing butterfly, we can get our profit zone bigger in order to capture, you know, a move that, you know, with a wider range than the tight butterfly. Now, in some situations, we want to tighten up the butterfly to reduce our risk, right? And especially when we're in a really high uncertainty, really high volatility market, the thing that I want to do is reduce risk, right? So we can reduce risk by using butterflies and condors and then narrowing the spread. All right, so by narrowing the spread, we're going to narrow the capital at risk. By widening the spread, we're going to have more at risk, but we're going to have a bigger profit zone to, you know, profit from. So different conditions of the market will do, you know, different, you know, ranges of butterflies, but prefer to use the wide range butterfly because it gives us that bigger structure for profit. These are all going to be defined risk, great for hedging. Yeah, GM. Here, go ahead and you can use this. Let me give you that link. All right. Now, so they're all defined risks, and all the trades that I send out with the alert service or whatever, or any trades that we do typically in the trading room, these that will be all spreads because I can keep the risk defined. I really like to keep our risk low. That's kind of my kind of theme as far as what I like to do. Now, these are, targeted directional swing trades. The question was what time frames I use. Typically, when we're doing swing trades, these are medium-term trades. They could be 1 day to 2 weeks maybe. So daily time frame is kind of what I'm looking at. But then I'll break down and I'll look at, I like to follow the 60-minute and the hourly, and I want to know where the kind of long-term trend is, and that I'll use the weekly. But typically the daily time frame is what I use. Now, these are all really great for what we call pinning trades. We'll go through a bunch of these here, which I call Lotto trades, which are very cool. Great, again, for high volatility markets because we can really reduce our risk. Plus, think about it. When we have a high volatility, what happens? Implied volatility goes up. Now, when implied volatility goes up, that increases the option premium. So this will also increase the, your potential profit because we're getting more volatility when we're setting up implied volatility when we're setting up a Butterfly or a Condor. Also great for trading high price stocks, which I'll show you some examples of how that can benefit. Trade duration, again, 1 day up to about 2 weeks. So when you go much further out than 2 weeks, you've got your money kind of dead money because the way that the butterflies and condors work, you really get the biggest impact towards that last time, week when you're coming into expiration to take advantage of time decay and volatility crush. The other great thing with these two strategies, no theta, okay? So this is gonna have a positive theta, no time decay, and you're gonna see returns where you can get, we've had returns of 2001, all right? So these are real trades that you can really get these kind of, crazy returns. So really, they're really available to you when you understand how to do the butterfly, okay? The wide wing butterfly, they all have they'll have a little bit higher risk reward. You'll see why, because you're putting up more capital at risk. Okay, so we'll go through a lot of examples and make it more clear for you. All right, so for example, okay, here, so the question was, wide wing butterflies, do they generally have lower risk reward? Okay, so here's going to be okay, so back up here real quick. Here's a narrow wing butterfly. All right, so narrow wing butterfly right here. Okay, look at this. So narrow wing butterfly, dollar wide spread. The risk on this trade is $10, 10 cents, 10 bucks. Okay, so it's a very narrow wing butterfly. It's a dollar wide spread between the 272, 73, 74. Okay, dollar wide. So $100 wide spread. Okay, that's your spread width, less your cost of the trade, 10 bucks. Potential returns 90. So your risk is $10. So the narrow wing will be the lower risk reward. So you'll have lower capital at risk, which gives you potential for a higher return on your capital if you hit it perfect. Okay, so we'll go through some more examples. So actually, you're correct. So if we make it wider and we hit our target, you're going to get the bigger return. So, I'll show you some really good examples of that. Hold on one second. I've got one more question. Yeah, oh, absolutely. Yeah, so that's right. So Ron, you took this at well, yeah. So here, yeah, go ahead and yeah, definitely use this link here, okay? All right, use that. Hey, good morning, Mesquite. All right, so hopefully that got your question, and thanks for the questions. All right, so here's an example of a wide-winged butterfly using puts. Now, the other thing too, we can shape these things directionally. So if we're looking for a downside move, when you're trading options, how do you, what option strategy would you do for a downside move? So you're going to either, if you're looking to go short something using options, you're going to buy puts, or you're going to sell calls, right? Okay. So if we're looking for an upside move, we're going to buy calls and sell puts. All right. So here's a put butterfly, and these are your risk is your debit paid. So you're going to have a huge positive risk ratio on that debit paid. So here's one that we did, and again, these are all various different trade alerts, or trades that we did in our trading room. So you might have gotten this in the trade room or from the alert service. So here was the trade. This was at this point in time QQQ, and this example is trading at 314.60. So it's trading right about here, and I use my indicators. These are based on momentum, just to kind of point those out. We had what we call cycle reversal, negative momentum. And so this is a trade that I like to do when we have what we call a kind of a momentum break. So we did this, a very defined butterfly targeting this area down here. Okay, so this was a Fibonacci area coming in right in that area. So we did this targeting this down to potentially 304. All right, so the target was set up, and that's typically, I like to set the target, the body at the target that we're looking for. And these are established usually using Fibonacci moving average, what I call price target mapping. And you're going to get that as part of your bonus. You'll get that target mapping course, so you'll understand how to do it. So we were looking for the target to 304. So we did a 314. It was trading at the time 314. So we bought the 314 put, sold the 304, bought the 294. So you can see it's $10 spread between these strikes, right? So $10, that would be $1,000 wide. Okay, one option contract equivalent 100 shares. The cost of this trade was $2.10. That your debit cost. So $210. That's your maximum risk. Now the potential profit here is the difference. Then you've got a potential to make 790 if we hit the top of the tent at expiration. So that's a 376% return, or risking $1 to make $3.76. But the great thing with the wide-winged butterfly, we put these on. We're not, I'm not looking to hit the top of the tent really. I mean, that's great. That's extra. That's the bonus. Okay. But if we get anything in between, we're still getting a fantastic return on our capital at risk, but we have a bigger, wider profit zone. So we might not make that 790, but we might make 100, or we might make 200. So we might make 300. So those are still fantastic returns, right? When you look at that. So here was the trade. Here's kind of where it went out. So it's trading here at 306. Okay, so we were looking for that target at 304, so it didn't quite make it there. Now the blue teal is what it is, the risk profile, that's what it is at expiration. And so this was at expiration. So this was almost, this was a really great return. So it went from $2.10 up to $7.82. So we had a profit here of $572, on that risk of 210. So this was a 272% return versus if you just done shares, you would have had a 3.6% return. Okay, so again, taking advantage of the time decay component, volatility collapse from the time decay and volatility, and then very low defined risk. So you can see, but look at that area of potential profit zone. But here's went out, so great return. Now, the other thing, when we do butterflies, we're going to, if you do multiple contracts, we're going to scale out of these because, the market can bounce around, but, you've got big potential for your upside, potential profits. Now, this one I like to point out because this is a really great example of how you can trade a really high price stock. Plus, this will show you how volatility and time at expiration, go straight to your pocket And you're going to see how this trade in one day went from making like $1 to $4. Okay, so 4 to 1 within one day, and that's what makes this a really great example. Plus, this was on a high price stock. This was back when Amazon was trading, close to $2,000 per, share. All right, so this is how you could trade it back then and how we did it. Now, in this example, again, it's a great illustration of high price stocks. So Amazon was trading at $1,782. So to apples, remember, one option contract is equivalent to 100 shares. So if you were to do, buy 100 shares of Amazon here, right here, we were doing this based on our indicators, etc. That would cost you over $178,000, right, to buy 100 shares. So, unless you're, a major hedge fund or whatever, you're not going to probably be going out and doing that. Even if you have a margin, it's going to be huge. But with this Butterfly, we did this trade and we were able to do this for like $80, 84. Let me show you. So pretty amazing. And then we had a 4 to 1 return increase in the same day. All right, so this is a really great way to show you high price stocks. So Amazon was trading at 1,782, and we were targeting that 1830 level, which was a key Fibonacci number, a lot of option activity. Now, if you bought the shares here and it went and hit 1830, you made $48 a share. So you made 2.69% return. But look at your risk. So you made 2.69% return on your risk of over 178,000 if it went down. I mean, that's huge. But we did the same trade, basically controlling a high price stock for $80. So we did the 820 call long, targeted the 1830, and then the 1840. So we had a $10 wide butterfly like this, okay? Spread width $10, so $1,000 wide. So you can see the spread width 1820, 1830, 1840, $10 between the strikes. The cost of this trade was 80 cents. So that's $80 debit. So instead of paying literally 178,000, we were able to control an upside targeted move in this trade for $80. So if we got it wrong, we lose $80, or we could have, stopped out maybe 50% or 60% of that. And the potential profit, though, is the difference between your spread width, et cetera. So if you did hit the top of that tent at expiration, you would have made $920 on your risk of 80. That's 1,150% return. So risk $1 to make 1150 versus here, you can see it could be a potential disaster. All right, so that's one thing. Now the next thing, and even more important, I guess, or cooler, is that here is the trade, a wide wing butterfly. Here it was in the morning, okay? So this is the day of expiration. So this is around 9 a.m., 10 a.m., Central. So at that point in time, the Amazon was trading at 1836. So it overshot the target that we had, 1830. So it's trading right here. So the purple is what the, analytics are showing you the risk profile, what the profit is based on time. So right here in the morning, this trade was up, went from 80 cents or $80 up to $230, okay? So the spread was up $150 per butterfly spread. So that's still not a bad return. So that's a 187% return, and we're up $150. So I'm still, I'll take that all day long, $187 return or percent return. So that was in the morning, but all that black area is what's still potential profit from time and volatility. And at expiration, what happens? Time goes to zero and volatility go to zero. So those are two big parts of the profit that are still tied up in that trade all the way into the expiration at the end of the day. Now here it was in the afternoon, all right? So this is, how that works. So look at that. There's hardly anything left from time and volatility because it's been sucked out. So now it's trading right here. So it's trading up a little, about 1832, but look at it's trading right there. And look where your profit is. So this went from now 80 cents or $80. Now it was up to 695 on that spread. So this was up $614 per spread in the afternoon. So it went, so that's a 769% return versus the stock. But in the morning, you know, you were up 180. So that's still not bad. And your return was, you know, on that was a 115%, I think, return. And then in the afternoon, your return now is up to, you know, over 769%. So that's a kind of 4-to-1 increase. Good question. Okay, question is what happens if they assign you the Amazon trade? Well, you're not going to get assigned, because what you're going to be doing is, and this is what, you know, I'll teach in the course, is we're going to be out of the trade before assignment. Okay, so you're not going to be in this trade. We're going to close out the butterfly. We're going to close out that short strike. So, you know, you close out if you're like if this your short strike's at 1830. Okay, you're going to be out of the trade before the close. You're not going to leave it into the close. You're taking your profit. Other question, what does it signify when you're coming back down to the backside of the tent? Okay, well, you can see here the top of the tent, that's your max profit zone. But if it goes down anywhere in here, that's still profit, unless you go outside of your long wings. Okay, so you're going to lose you're lose if you go outside your long wings, but you're going to make, so your long wings were your long 1820, so that's your long wing here, and then your, you know, short and your the 1830 and long 1840 here. So these are your long wings. So between your long wings, anywhere in there, you make money. All right, so you only lose money if it goes outside your long wing there or your long wing there. Okay, now in the course, I'll show you how to adjust these, manage these, but these are examples. Okay, so just to kind of give you an idea of the potential. And then the course will go through, you know, how to do it, how they work more specifically. Now, we've been doing a lot of these called condors and put condors, because this will give us a wider profit zone, and they're really going to keep our risk super low, and we get a super nice high return on these types of trades. So here's one we did recently. Again, these are alert trades. These were sent out to the alert members. This was on Walmart. And so we did this trade. We've done it. We were in this trade a couple of times. Actually, we did this trade again. We did a butterfly on Friday, but went ahead and got out. It just started to lose momentum. But anyway, this is one we did recently on Walmart, a long call Condor. Let me take a look at your question. Are there instances when you can sell off 2 of the 4 legs of the butterfly, max profit, let the, sure, you can, you have great question. So you can leg in and out of butterflies, and you can leg in and out of condors. Okay, so let me just kind of show you. That's the other great thing that we do a lot of times. We'll just leg the spread. All right, so, you know, if you're, you know, got a good view directionally, these are a great way to get out. So now, if we're not sure about market direction, it's going to go all over the place, we'll just go ahead and put on the butterfly as a butterfly spread. We won't leg it. Or if the market's going up crazy, you know, it's hard to kind of, you know, trade directionally, you know, intraday, unless you're really good, we'll just put on the long condor as a spread. But, you know, I love it. The best way really to trade these is if you can leg in. Okay, so let's say you get a really, let's say you want to go long, go long, and then you buy your call here, you know, you get it perfect, and the market really starts to move up. So you're long that call, and you might be long the call debit spread, and then you get up here, and then what we'll do is then we'll sell the credit spread against it to make it the condor, or we'll sell, you know, it goes up here, we'll sell it and make it a butterfly. So we can leg in, or we can leg out. You know, if the market starts to unravel and we get nervous, we can close out the debit spread side, leave the credit spread short, you know, on either one. Or if, you know, if you're got a put side, you can do the same. So just a lot of flexibility to leg in, leg out, and that's a great question. And we'll also go through these, that's what we call adjustments. We'll go through that, a big part of that in the course. All right, so here's one we did recently. This was on Walmart, and we're trying to really control risk. You know how crazy the market's been. So we set this up on the 17th. Walmart was trading at $93. So we had, you know, the momentum was still there. We had a good, fairly good trend, and this looked like a pretty good setup, but we wanted to keep our risk super low. So we got in right here. You see momentum or indicators here. And so we got in there and then got out on the 25th, right there. Okay. So it kept moving, but the markets, you know, if you've been trading, you know what I mean. The market's been all over the place. All right. So this was a trade that we did. So we wanted to keep our risk super low. So we did this trade, and our risk here on this trade ended up with 78 cents or $78. So we went long the 93 call, short the 95. So very narrow, wide spread width of $200. And then we went short the 97 call, long the 99. So this creates what we call a long call condor. All right, spread width $2, $200. Cost of our trade was 78 bucks. So if we messed this whole trade up and we didn't stop out, we would lose 78 bucks, which we could live another day with that kind of loss. Okay, so potential profit though in here would be 122 bucks. That's 156% return. So you can see the beauty of these controlled low risk, 78 bucks, potential to make 122, positive theta. So that's another thing too. A lot of times I like to put these on Thursday, Friday. We go through the weekend, we have positive theta. Great way to trade. So here's where it went out. Here's the profile, what it looked like going out. So we were in at 93. The 25th we were getting out. It was trading right here at 95.09. So the spread went from 78 to 200. So we're up 122 bucks. So pretty much max profit. But if it had gone out in here, we'd still make a decent profit, but not the max. So it went out at 95.09, and we were up, you know, $122 per spread. So if you did one spread, you made 122. If you did 10, you can kind of, you know, do the math on that. So that's a good look there. Now this is another one that we did not too long ago. This was on Alert Trade SPY, and so this was for a short trade, and this was doing a put condor, so really controlling our risk, but we had a huge big return on this. And so this was a really fast trade. So that's the other thing. These are, we can do these really short duration. So we did this using a put condor, and this is one we actually legged into. So the question was, can you leg in? So we actually set this one up doing a put debit spread, and then added the credit spread to make it reduce risk and increase our potential profit return. So it was trading at 568 on the 10th. So right here, we were breaking that 200-day moving average. So we went short right there. And then you can see the next day, we had that big surge down. You see the big surge down to 556.97. So really big, fast move down. So we had the put debit spread, then we added the credit spread to it to reduce our risk. And that also increased our return on capital at risk because we reduced that risk. And so we ended up with this adjusted butterfly. Look at our risk here, $43. That's it. Boom, 43 cents or $43 is our maximum risk on this trade to make potentially 257. All right, so it's a put condor, okay, with the risk of 43, potential to make 257, 597% return. So we have the 563, 560 put debit spread we originally started with. Then when it moved down, we sold the 550, 550, 547 and reduced our risk to 43 bucks. Potential return then increased to 597. Positive theta, no theta decay. And let me get rid of that. I messed this up. One second here. What did I do here? Oh, here we are. Oh man, messed up my drawing tool. 1 second here. Here we go. Sorry about that. yeah, so that, reduces our risk there. Then we have that potential really big return on that lowered risk. So here's the trade here, the risk profile, what it looked like, and you can see this was then, we had this put debit spread on, long the put, short the put, and then, we had that on, and then when it started to rip down, we added the other side. This was one we legged into. So we shorted that bull put credit spread there. We had this really wide profit zone, okay? So really cool setup, and we reduced our risk down to 43 bucks. So the spread then blew out. Now it was at 300. Our risk was 43. So we were up $257 or 597% return, okay, in one day. So this was this was an alert trade sent out to the members. And a lot of times you will do this in the room if it's early in the morning. The trading room's open from 8:30 to 9:30 Central. 1 second here. Yeah, I have to look at that later here, Richard. All right, so there we go. Now these are really fun. These are what we call the Lotto ticket. Okay, and this is what you can do with butterflies. And this is what one of my members said about it. So really, really kind of summarized it. He said, the butterfly strategy is one of my favorites. So it's the big winners, right, that eventually make the difference in your trading account. With all the so-called low-risk option strategies being sold to the public, an account without the potential to hit that really big one once in a while not betting the farm is a slow ride up a long hill. So, what I talked about earlier is I'm looking for, those singles, doubles, but occasionally you get the big ones, and that could really make a difference. So these are what we call the Lotto ticket type trades. So when I see a really selective butterfly or potential for a pin or something like that at a certain strike, we'll do these for super low risk. So we're going to, keep our risk super low if we do get it wrong, but if we get it right, we can really increase our potential profit and return. So here's one we did not too long ago. This was on SPY, and this was it was on the 6th. It was trading at 573.80. Now we were targeting then, we were doing this target trade, and we were looking for a move to 560, I believe was our target. So we did this trade. So somebody asked, what, are these easy to understand? So here's one that we did. This was sent out to members. So here it says when it's a new trade, I'll say new, and it says new SPY pinning trade. Okay, that means we're going to look for this trade to go out at a certain strike at expiration. That's what we're shooting for. And so it says trading at around 573.80. So, I send this out. I can't say exactly where it might be a little bit different by the time it gets out. But we use a service called Telegram. So it goes out within seconds, and it's a free service. So it says here, binary put option butterfly setup. So it says buy one butterfly. Okay, so it says buy one butterfly. This is what it looks like on Thinkorswim. 10 March, that's the year 2025. So you're buying the 565, 560, 555 put butterfly. So you're long the 565 put, short the 560, short the 560, long the 555. That's how it's just defined by when it's sent out, in your order. So it said do this around $40 or lower, 40 cents, that'd be 40 bucks. So the debit paid will be your risk. All right, so that's tells you exactly what you're doing there. Now, here it was, that was on the 6th. Here it was, and I'm constantly updating these if there's something that needs to be done, adjustments, or if you need to take profit or something comes up, I'll send out an alert to that. So here it is on the 10th. It's a SPY short pinning trade. Trade expires today. Okay, it's now trading around 567.63. So we got in there. So it says if long that 10 March put butterfly there. Look to take some profit today on any move lower towards 560. And then here it is later in the day, short pinning butterfly, now trading at 561. So it's going right to our target. If long that butterfly, make sure you take profit today, close trade out prior to the close. All right, so that was that's how descriptive these are when I send out. So here was the butterfly. We set it up here, and we were targeting down to that 560. So right there, my indicators are down. So this was just a great setup. So we did this, and I look at option activity that are really key as well. So this was the 10 March, of this year. You can see the option expiration here. So 565, 566, 555. So here's the spread. Long the 565, short the 560, short the 560, long that. So put butterfly right there. Total cost, total at risk, 39 cents. Okay, spread width, $5 between the strikes, so $500. Cost of the trade, 39. Potential return would be $461, or that's 1,183% return. So that's what would be if you get there, but and there's still a great return. Now this one almost pinned to the penny. So here it was. Again, this was alert trade sent out to members. So here it was, went from 573. Then on the expiration day, now it was trading pretty close to where we were shooting for. It was at 560.32. So our butterfly target was 560. All right, so here's our long put butterfly. And this one we didn't leg into this. Okay, so this was pretty much nailed it. So we went from 39 bucks to 456, so up $417 per one spread, 1,069% return in that 4-day period. So that was really, really cool. So that was one pinning trade to show you. That was what we call a lotto ticket trade. Sent out to members. Here's another really unbelievable one. This is one that we did also, pinning trade to members. This was on Tesla. And so this was about as perfect as you can get. So this was trading at 189.35. And then we were looking for a target in this example up to 200. So I set this up on the 8th, on the 16th. Now it was trading at 200. That was where we're looking for it to pin. So this thing was up $231 per trade. It was up 1,925% return. All right, so here's the description. It says new Tesla long binary monthly option pinning trade, trading at 189.35. This was on the 8th of February. Trade set for a potential monthly expiration pin at $200 next Friday. So it says, buy the butterfly here with the 197.5, 200, 202.5. So $2.50 wide spread. It says buy it for around $12. That's 12 cents or $12 debit paid. That will be the risk. So that was the trade set up, sent out. Okay, 12 bucks to try to get in, and that's where most people got in. And then you can see here it was on the 16th day of expiration. Binary monthly butterfly trade around 200. Butterfly going out at $215 per spread, 1,791% return. Make sure to close out trade prior to the close. Here it was at the end of the day. I'm going, wow, almost a perfect pin. Butterfly trade now trading at $200. So going out at $230 per spread, 1,019% return. So this was not experienced in my life, this one so perfect, but this is the one that we did have. So here was the entry, here was the exit, and you can see the spread here was doing the 197.5 call, targeting that 200, long that 202.5. So did that, targeting that 200 strike. We did it for a total risk of 12 cents. That's $12. Okay. Spread width, $2.50 between spreads, 250 bucks spread width. Cost of the trade, 12, 238 potential profit, potential return, 1,983%. And that's where it went out, right at the top of the tent. Now, we're going to be scaling out, but we'll try to keep some for the very end. But that's where it did go out, right there. Boom. So it went out right there where we're looking for 200. So this was up $238. So the point is, you can actually make these types of returns using the right strategies. Okay. Yeah, here's the link again. George, put this special. It's Power Cycle Trading, www.powercycletrading.com. /special. Yeah, let me just put that in real quick for everybody. Here you go. Okay, and then, put in, once you click on it and pick the package you want, then put in small cap BF 15, and then just use that. You'll get that 15% discount. So that was one that was really, really exciting. Here's another one that we did not too long ago. This was, again, these are all alert trades. Here was on gold, GLD. And so this is another really great penny trade. So gold was trading here at 222.85, and so we were going to target 230. Now, we originally on this trade we were targeting 225, did an adjustment, and again, I'm constantly sending out any updates that you need, adjustments or whatever, so making it really clear for you. But we did this butterfly. We set this up originally targeting 25. We set it up for $24 around that area, and then we did an adjustment here the next day on the 9th. And adjusted it up to the 230. So I go through, show you how to do it. We'll talk about that in the course. And then here it is on the 16th. It's going out close to where we want it. Now it was trading at 229.88, trending towards our butterfly target of 230. If long the butterfly here, 227, 230, 233, look to take some profit today before the close. Now here it is at the end of the day. Sit this out to all the members. Trading around 230.50. Boom. Looking good for a 230 pin. Currently up around $200 per spread, 689% return. All right, so this was another penny trade, and this was on gold. So got in right here. We're looking at this target 230, and that was where we were getting out. So question, when you're employing your price target mapping, which Fibonacci level do you know how to choose? Yeah, well, that's another thing. It's a great question. Now, if you take the course, if you sign up for this package, again, here's the link. You're going to get my Fibonacci price target mapping course. It's a 3-hour course, which will tell you exactly how that's done, Wayne. And we'll go through in the course next Saturday. I go through using the price target mapping in the course when we're setting up pinning trades. Okay, so you're going to learn how that's done and how you select how you select the points for your Fibonacci. That's a good question. So you will learn that in the course. Plus, you're going to get that Fibonacci price target mapping course, which is even more detailed. But the course next Saturday, I will go over, how I set up my Fibonacci levels. Okay, so you'll learn all that. So this course is very extensive. It is a master's course. I mean, it's very extensive. Yeah, here you go. 1 second here. Yeah, and I've got some other really great trades I want to show you and share with you, so don't go anywhere. Don't go anywhere. All right, so that was GLD, so going out right there. So we set this trade up, targeting that 230, which I'll show you how to do that in the course with your fib levels and all that. So we did the 227, 230, 230, 233. So $3 wide spread, right? So $300 wide spread. Cost of our trade was 29 cents or 29 bucks. Potential profit, the difference, 271 on that risk of 29. That would be over 900% return. All right, so that was on GLD, and then went out right there. Not perfect, but very close, up $202. So the spread went from 29 to 232. So up 203 bucks, 700% return. Now here's another thing that we'll go through in the course. This is another section that's in the course. So this will be part 3, and this is so important. So especially when you're in crazy markets like we're in now. So this is how you can hedge and how we can optimize a hedge with adjustments and do a trade where we can turn it into a free trade. So, we might start out with a butterfly or condor on a call or put, and we can make certain adjustments if the market's, moving where we need it to move, and we can turn the trade into where we eliminate the cost. So we recoup our full debit cost of the trade, the original cost, and we recoup it to zero, or we can make it even a credit where we have money back. All right, so really, really great if you understand how to do it. So here's an example of one that we did. This was on a QQQ short. So QQQ was trading at 365. So we initially started this out as a put debit spread, kind of like that SPY trade I showed you earlier. So on the first, we started out with made this into a free trade. And at expiration, it was max profit. So we went 365. We made the adjustment when it was down to 354. And then we took our profit later when it was at 359. So kind of hang with me and I'll show you kind of how this progressed. So that was the trade setup here. So, my momentum indicators, I use certain things I look at. We'll go through tons of new examples in the course. So really, make sure to join us for that. You'll get your money's worth, and you'll get your money back pretty fast from these trade setups. So we initially started this trade out as a put debit spread with a really good positive risk ratio. So you can see here we went long the 6 October 364 put 360. So we had a put debit spread, and we had this on for a total debit of 121. All right, so it had a potential really nice positive risk ratio. So spread width of $4 or $400 less our cost of the trade 121. So a really nice put debit spread. Okay, so if it went out here, at expiration, we'd be at 279, 230% return. Now the problem with the markets when you're in a really volatile market is they can go down real fast, right? But what happens a lot of times, you'll see knee-jerk reaction back up. So typically what we will do, this is a great strategy for that kind of potential hard down and knee-jerk up, because we can, when it goes hard down, what we do is we sell an out of the money bull put credit spread to reduce our cost here and, increase our potential return based on a lower cost. All right, so it was trading at 359. So then it breaks hard to the downside. All right, so when we set the trade up, it broke hard to the downside. Now it's trading at 354. So we added the bull put credit spread here. So we sold the 354, 350, added that to it, and we received in a credit of 141 bucks. All right, so we had that put debit spread, and then it ripped down. We sold that out of the money bull put. So I'll show you how to do that, the correct delta, and how to do that so you're not going to get, exercised. And so I'll show you exactly how that's done with the deltas and stuff that you need to know. And so it ripped down here. Then we sold that bull put credit spread, and we brought in 141 bucks. So we had a debit cost of the original trade, $121. And when it ripped down, we sold a bull put credit spread, brought in 141 bucks. So look at that. We recouped our full cost, but we also now actually had a credit. So if the market had gone straight down or then straight up, we would still make 20 bucks on that trade. Now it went out exactly where we were hoping it did. So it went out right here, right in the middle of the spread, right at the end of it, right there. And so this was the max profit. So we had a max profit on this trade of $420 on zero risk. Had zero risk on the trade. So that's what we constantly shoot for if we can. All right. So we had the trade credit of 20 bucks. Potential was to make 420, and so that's where it went out. So if you'd like to master these really high reward, low risk strategies that can work in any environment, but especially right now, but this is pretty much what we've been going to for the last month at least, is mostly butterflies and condors. So make sure to take advantage of this opportunity in this course. And again, you can get into this course. It's only 167 bucks if you sign up today using that promo code. Let me give you that one more time, then we'll go through all the things that you're going to get. Take any more questions, look at whatever you want to do. It's today's interactive. If you've got Yeah, somebody wanted to look at natural gas, we can do that too later. So here's the link again, Barbara. Use that special link there. Use Butterfly BF15 as your small cap promo code, and you'll be good to go. So this will be $197 when I send it out next week. But if you sign up again today, the course will be next Saturday, the 10th of May, 11 a.m. Eastern at 2 or however long we need. And then we'll have part 2 Monday at 4 p.m. to 5, and then we'll do a Q&A the next day. So just point out, if you've been a member, this is my old lab. He just passed away a month ago. That's Blanco, and I'll show you at the end my new lab. So I've got a new member to my family now. If you stick around, I'll show you a picture of him. So anyway, this is everything you're going to get, just kind of a summary. So let's go through it and take questions as we go. So you're going to get my spring bonus. You're going to get not 30-day trial membership in package 1, but you'll get 2 months. Okay. So you don't have to start your your membership to the trading club. You can start it whenever you want. So once you start it, then you're going to have 60 days. Now, if you want to continue on, which I hope you do, then it's $97 a month, or we have other different packages you can use. So the live course, $1,600 value. It'll be $197. Today it's $167. So you're basically, 89% discount off the course value, $1,600. Now, you're going to get my Fibonacci price target mapping. Now we're going to use this in the course to use it for, our identifying our targets. Now I'll go through in the course, I'll go through Fibonacci mapping, how I set my price targets up using Fibonacci, but this course is more extensive for you. So it's a 3-hour course. So you'll get that as a bonus. Now, if you have these already, these are just add-ons, but the course is $167. Then you're going to get my start trading options today. So intermediate option course for you, $197. These are all priced on my website. And then you're going to get access to my trading club. So it's $97 a month. You're going to get this for 60 days. We'll do a support follow-up Q&A. We'll do that on Tuesday. You're going to get my option trading tutorial, another option course, on all the different Greeks. And you'll get my manifesto of 15 different option strategies, how they work. All right, so a lot of great value there. So total course package over $2,700. So today's your price, $167, 94% off. So you'll get the live course access plus everything recorded, broken down in modules. Yeah. Yeah. Here, if you want to take it, join us again. It'll be, you can do that. Let me show you how far in advance you send out alerts. They come out immediately. Okay. So I'll show you here. So hold on. I mean, they come out within seconds. I'll show you some more examples. So here, let me get rid of this drawing pen. It's kind of annoying. So yeah, use this right here if you want to join us. Evelyn, I'm not sure. I think I'm messing up your name, but here, use this. Yeah, I'll show you some alerts that, again, they go out within seconds, okay? So that's course package 1. And then I highly recommend my alert service, obviously, but this is course package 2. We've had great success, and these are when I send it out, these are very defined risk trades. So you'll get the alerts for the next 4 months. You can stop and start it yourself when you want. So if you do go on vacation or, trip or whatever, you want to pause it, you can pause it so you're not using your time. So you're going to get 4 months of the alerts, but I'm going to give you also my trading club. So I'll show you what that is. The trading club, you get access to my virtual trading room, our Q&As, discounts on everything, and all kinds of educational stuff in the members discount, area. All right, so but you'll get that for 4 months plus an additional, so 5 months there. And so when I send out the alerts, I've got 5 different types, selective ones that I will send depending on the market conditions, what we're doing. And so, but lately we've been, like I said earlier, because of the risk of the market, we've been doing a lot of condors and butterflies to reduce our risk. So I might be sitting at a butterfly or along condor. We do a lot of counter diagonals. We do these butterfly pinning trades when the opportunity sets up there. Breakout reversals typically are debit spreads or credit spreads. And we've been doing quite a few earnings trades lately since we're in earnings season. So you might get any of those. You might get one or two or three or four, per week, different ones. So this week we did an earnings trade setup. We did a calendar. We did a condor. So a lot of different ones we've sent out. Yeah, Brian, here. There you go. Okay, so that's what you're going to get there. And then you'll get the alerts for 4 months, Clover 5, so 597 next week, today 507. And typically 8 to 12 stocks or ETFs per month I'll send out. This week we did, I think, 3 or 4 trades. So when I do send out the trade, you'll get a specific trading guide. A lot of members just want to do their own thing. They just want the trade. So, if I send out a directional trade, they may just, buy the shares or the options, whatever. But when I send out a trade, I always give you the option spread trade that I would recommend doing for that trade. So that's the trading guide. So I'll do a trade setup video review that day later after the close and show you, tell you why I did the trade, etc. The trades are listed in archive. We do a weekly Q&A live and recorded, so you have access to that for the next 5 months. Do a video newsletter every day after the close, so telling you the market, my view in the market, what's going on. You'll get that for the next 5 months. Access my virtual trading room every day during the week, 8:30 to 9:30 Central. You'll get that access for the next 5 months, and discounts of 60% off all courses and software on my site. So you'll get a member's code and I'll give you a 6% discount there. Okay, so that's everything that you'll get. And today, you'll get that for 507. Let's go through the alerts kind of summary. So again, I started the first service back in May of 2018. Since then, I've added 4 others. So I've got 5 total different types that I send out. But the total summary since through yesterday, I've had 864 trades that we've closed out, 625 winners, 59 losers. Break even, 180 losers. So high winning rate, 79% around that. Again, these are unaudited, just kind of a summary of the trades that we've done. And then let's go through a few examples. So again, here's what you're going to get. Again, use this special link here. Let me put that up one more time. Let me get that out to you so you can take advantage of that. And again, this is one of my favorite strategies, the Butterfly and Long Condors. So, when I'm trading, my favorite strategies are going to be the Long Condor butterflies, debit spreads, and calendar diagonals. But this is such a huge part of the trade portfolio that you should use, especially when we're in markets like we are now. So I like calendar diagonals, but when we're in a really fast moving market, we really want to define narrow risk. These are the kind of that I go through. So it's really important that I think you understand how to use these. And for $167, you'll get your money's worth and get it back fast. So again, if you want to make sure you haven't already taken it, you can see it in your membership area. You'll see Butterfly, and you can take repeat if you want. Just let me know. And then you're going to get the Fibonacci price target mapping as a bonus. So these are just added because I think these are going to help you moving forward. But if you already have them, then again, these are just additional to the course. But the course itself is going to be 167. These are just add-ons. Now here's kind of a summary of what we're going to cover in the course. So it's a very extensive course. So part 1, we're going to start out, going through what the option Greeks that are kind of vital to making what affects the butterfly and long condor. So, things like how to use delta and your volatility and time decay. Okay. So really important to understand that, to understand then how these things work in your favor. All right. So we'll go through the impacts, how to use theta decay, the impact that it has on these two strategies, the importance of volatility and how volatility crush, helps these two strategies, how option pricing works. So important that you understand that. So for any of your trades, once you understand this, it'll make it more, clarify option trading to you, and, better in general. So we'll go through that, how option pricing works, with theta and volatility and applied volatility. And then we'll have a section of the course where we'll go into using Fibonacci price target mapping and standard deviation for selecting your high probability targets. Okay. So we will cover that, but this is covered extensively in that bonus course that you'll get on Fibonacci price target mapping. But we will cover that because it's an important part of setting our targets. So that's part one. And then part two, we'll go through every variation of a butterfly. So this is what's really going to make it work for you, because I'll go through how, why, and when to use every different variation. So you can see when would you use the long call or put butterfly, when would you use the wide wing butterfly, when to use the broken wing butterfly, when to use a ratio butterfly, a broken wing ratio butterfly, iron butterfly, Lotto, vacation butterfly, long condor. So I'll go through examples of each variation in the course. So then you're going to have an understanding to know, okay, yeah, I like this. Okay, I can see when to use it. I've heard about the wide wing. I'm not sure when to use it now. Okay, now I know when to use it. What's a ratio butterfly? So, when to use that. What's a broken wing ratio butterfly? And then the long condor, there are variations of those as well. So you're going to get every variation. So you're going to know, and then you might come down, okay, I only want to use the wide wing butterfly, or, I really like that broken wing. Okay, so it gives you an understanding. And so then, again, what are the best timeframes to use to capitalize on these two strategies? And then should I use stocks, ETFs, index, futures, whatever? And then how does volatility collapse and theta work to, profit the butterfly? So you're going to understand that through the course. And then how do you get those returns of 10 to 1 or higher? So those pending trades that I showed you. And then a really nice big part of the course is also the monthly penning type trades. So this is kind of a new stream that you can get 12 times a year. We have these option monthly expirations. So this is when we look to do these types of strategies. So we'll go through a section in the course for that. And then how to do that price target mapping setup. How do we select our targets for the penning trade? Okay, so we'll go through that using price target mapping, which is a combination of unusual option activity and Fibonacci and moving averages. So really big part. And then we'll go through the next part of the course. We'll cover the long condor. So again, this is such an important strategy. And again, we've been using a lot of these lately. So this is one that we can use to give us low capital at risk, always gives us positive data, and we're going to get a returns of 100, 200, maybe 300% on this strategy. So how, why, and when to use the long condor, okay, in your directional trading. And again, this is one that you can really give you a lot of flexibility on this trade to leg in, leg out, put on exactly when you want it. And then part three is going to be just totally dedicated to hedging. So start out in part three with the progression of hedging, okay, going from shares to calls, et cetera. I'll just go through a lot of the kind of progression. And then how we can use the butterfly and long condor to hedge core trades. And then I'll show you how to use the butterfly defense for defending a vertical debit or credit spread. Yeah, so yeah, if you've got your membership expiring, and if you buy today, you'll get the additional, you're going to get back in, right? I think that hopefully that answers your question. So if you sign up for the course today, Daniel, package 2, then you'll get your actually you'll get, if you want to, yeah, you could renew for 6 months, and then plus if you do the course, you'll get another 4 months. So just make note of that, and we'll do that for you. So for example, you'll get 6 months. You'll have to pay for that based on your current 6 months it rolls off. So whatever that might be. Plus, if you want to do course package 2, then you'll get another 4 months on top of that. Or if you do package 1, you'll just get, you just do package 1 or do package 1. But if you did want to if you're already a member and you're renewing and you wanted those extra 4 months, you can do that. So then you're going to have 10 total months again. Okay. Discount code. The discount code is the same for both packages. Just put in here. Let me go through it one more time. So just put in the special link there. Okay. Okay, so here we're going to go through it real quick. So the question is, what is the discount code? So just put in that Power Cycle Trading /special. Okay. All right. So then you pull that up. Okay. Either here it is, copy or paste it right here, right there. C4 powercycletrading.com /special. Okay. Copy, or you should be able to click on that link. Okay. So put that in, and then this will pull up this payment link with the description. And then all you need to do here is, next time I'll make this bigger, put in Butterfly BF small cap. Next time I'll make that bigger. BF 15, and that's going to give you the discount. So let's go through an example here so you'll know. Now it'll list everything here so you can see what you're buying, right ahead of time. You get that 2 months of the trade club, all those exclusive bonuses. So today, this will be next week will be 197 if you sign up today, 167. So click here, okay, and then make sure to use that small cap BF on either one, the course package 1 or 2, the same as used. So 167, if you want my indicators, is a 5 steady set indicator for Thinkorswim, TradeStation, or wealth charts, not wealth charts, but TradingView. You can add those to the list if you want. So, and then you'll get that discount. Now, if you want course package 2, it'll be the same discount link. Just come down, just, click on that. It's $5.97, but, use the BF 15. And if you want the indicators, you can add those. There's a 2-pay for this. If you want 2-pay, you see down here. And then put in that BF small cap. Hit apply, and you'll get that 15% off. Also, PayPal has all kinds of different arrangements you can do. PayPal extended credit, all kinds of stuff that they do. So just to point that out, they were a lot of good stuff there, okay? And then let's see. So then, we go through the progression. So this alone is a full course here, part 3. And then so end up with step-by-step checklist, when and how to put on the butterfly, take them off, execution, adjustment. So a lot of questions on assignment risk. So we have a total resource section there. And I go through the course, how to avoid assignment risk, and what to know, what you need to know, and there's no. We've never had anything assigned to us, so there's nothing. We'll go through the course of what you need to know, basically, and you'll never have to worry about that, okay? And then you also get a trading library of, 58-page library of different butterfly and long condor trades, where it's a really great benefit to helping you learn about the trades by seeing other examples. Okay, so you'll get that. Here's a really nice note from Richard. He said, Larry, you're one of the only ones that I know that provides competent, realistic instruction on how to have that Houdini escape hatch plan to utilize when various types of option trades go against you. It allows a trader to calmly use their head to make appropriate trade adjustments instead of wildly panicking and having their heads handed to them. I greatly appreciate you sharing your hard-earned, profitable trading knowledge with us. So on that note, here's somebody asked about the alerts, how fast they go out. Here's what we use. We use this service called Telegram, okay? So when we use Telegram, what you're gonna see is this goes out so fast. It goes out within seconds, but I'm very descriptive. We did if I have time, we did a Walmart, actually Butterfly on Friday, but then it started to stall, and I sent out a note to go ahead and close it out. So, that was in and out on that one just for breaking the small profit. But anyway, I sent out adjustments constantly if needed, okay? And so here's the bonus package, just kind of a review of this. So everybody here today will get a bonus price target mapping using Fibonacci. So this is the course I did. It's a 3-hour plus recorded course. I had a 39-page training manual of the course, the videos. And so it goes through what I call my price target mapping, which is a combination of Fibonacci, but also incorporating trend lines too, which I call automated trend lines, support resistance price action, what I call price action, standard deviation forecasting for options, and then any unusual option activity. So it's kind of 5 components to it, but it really gives you really great targets to trade to or trading, for stop loss or profit target areas. So you'll get that. Then you're going to get my start trading options today. So if you're just kind of starting out, this is a great course to kind of refresh yourself or whatever. And this course will go through in more detail benefits of options versus stocks, what you need to know about your options, must know basics, mastering puts and calls, how option expiration works. So this is a really good course because it tells you how that works, so you understand. You're just going to make you more knowledgeable. And then there are 3 strategies that I teach in this course. You're going to learn how to use the covered call. You're going to learn how to use a covered call with a protected put called a collar, and you're going to learn how to use the vertical debit spread plus resource. So you'll get this additional. This is a course that you get just to add to your trading library for options, and then you're going to get 30 days, not 30 days, but 60 days for my trading club. So trial membership for 60 days. You can then renew. So the big part of this is you have access to my virtual trading room every day during the week from 9:30 to 10 a.m., 10:30 Central. Okay, come in, ask any questions on any trades you have or see what we're doing. So you'll have that access every day for the next 2 months. I do a daily video update every day after the close. You'll get that. There are video training videos from our Q&As or archives, so you can go back and look at those. We do a weekly Q&A every week, live and recorded. You'll have access to my Traders Educational Vault and a discount code for anything on my website. You'll get 60% off of any of my other prior courses or any of my trading indicators, my software. So if you go here to Power Cycle Trading, anything I have on the site, it could be software, it could be, whatever, you'll get a 60% discount. You just come down here. So for example, here, if you're buying my scanner, 397, you put that in, put your membership code in, you're going to get 60% off that price. All right, so anything on my website, so that would be, any prior courses. So if you wanted to come over here and, buy any of my courses, get started trading, you're going to get that as a free add-on. Ultimate Option Guide course, all my courses, synthetic options, any of these, you get a 60% discount. So that's a great benefit. And one thing I always like to point out is that here's one of my really, longtime members said, Jay says, reading books is fine, but seeing the actual option trade setups makes a huge difference. So that really says a lot there. And then here was one, he said, wanted to say my option knowledge has leaped exponentially since joining your trading club. All right, so that was just a little feedback there. Now you'll get my support resistance. We'll do a follow-up Q&A the next day. Plus you're going to get that trading room, for 60 days. So you'll have access to that. You're going to get another option course here. This is a course that I put together just specifically on the Greeks, delta, gamma, theta, how option pricing works, standard deviation. So you're going to get that 60-page option guide with videos. So you'll get this. So This will really beef up your option, library. And then here's one last thing. You're gonna get my top 15 option strategy guide. So this will go through a lot of different other variations. So what the heck is a vertical ladder spread, or what is a long strangle straddle? So this will go through trade construction, when to use. So just another thing that you could add if you're not familiar with some of these strategies, just some more additional stuff there. Yeah, the indicators are available for TradingView. Okay, now here's the alert service kind of summary here. So this is one of my members. This is Waleed. He actually lives in Kuwait, and he said I've mentioned one thing. I'm subscribed to a lot of services who send out trades. Some are good, others are not that great. But one thing I would like people on this webinar to know is when I get a trade alert from Larry, I do it blindly, as time has shown me. This man is dead accurate in his recommendations, so I really appreciate that. And it's not been easy lately, so we still have really maintained our winning rate. But the way we've done it, or I've done it, is reducing risk, using, typically, we've been using, again, a lot of long condors and butterflies in this environment. So it's a really great strategy for you to learn. And then Dan says, you're very diligent and totally thorough with your analysis. That is the foundation of success. I paid for my subscription with the first 4 trades I took when I was just learning how to trade options. So again, you're going to learn a lot just from the alerts that are sent out, because I try to be very descriptive of them so you understand how they work. So you'll get an option guide, but again, just to point out, a lot of members just do their own thing, but I'll always give you an option spread on the alerts that are sent out. I'll give you the entry level profit targets, that I typically set up based on the option activity and that price target mapping. What option series to use, stop loss levels, guidelines, and I'm constantly updating. And if we need adjustments, I send those out by alert. So then you'll get a trade setup video review of that trade later in that day. I do the video newsletter later in the day. You have weekly Q&As and live and recorded, so you have that for the next 5 months. Access the virtual trading room for the next 5 months, and discounts 6% off and Traders Educational Vault. So really an extensive thing that you're going to get on all of that. Yeah, so when you add, so if you TradingView have got the indicators here, hold on. So when you sign up for whatever package, let's say you go in here, come down here, add the indicators, put in your discount code, and you'll get the indicators. They should, yeah. All right, so that's basically what you do, and then TradingView. Then we'll give you I think we have it set up in the members area where you can select. But anyway, TradingView is one of the platforms where you'll get my cycle reversal indicator, my momentum indicators for TradingView, or Thinkorswim or TradeStation. Okay, so just do that if you want the indicators on top of everything. And if you have any questions on any of this stuff, also send us an email, support@PowerCycleTrading. Let me get that, trading.com. Okay, so if you have any questions on the course or any of the stuff provided, also, feel free to send us an email there. All right, so here's a summary: butterflies and again, just to not to be a broken record, but in the different market conditions, I go to different strategies. And in this market, we've been doing a lot of either condor, long condors, or butterflies. Okay, so started again the service back in May of 2019. We've had 221 trades closed, 160 winners, 16 break even, 45 losers. 80% win rate. These are very high potential returns. You can actually get 25 to 1. Average loss, 75 bucks, very low risk trade, which is why I like to go to these, but potential for big reward. So I already showed you this one earlier. This was the Walmart trade. All right, so I'll just kind of go through these pretty fast, but that was one that we just did recently. Here's another one we just did recently. This was IBM. This was a long put Condor. And so this was an alert trade. So we set this one up on the 18th of March. Now these are just butterfly condors, but during the same time frame, I may have sent out an earnings trade, or I may have sent out a calendar. So these are just going through this category of the trades. So we did this trade here. So IBM was trade, it says new IBM short. So it'll tell you. So you'll know this is brand new. And it's where is it trading when it's trading at 246.45. So some members just, they might just jump on this trade and just buy puts or short shares. But I will always send you the option strategy I think that would be appropriate for it. So then I give you a little bit, I'll try to give you a little bit of a review of why, the trade is being set up. So I say here, a daily cycle high retracement reversal up to 21 exponential moving average. Daily negative momentum with a downside momentum cross. So this is something I'll look at, and I'll explain that in the trade room or in my courses. First target 1, 240, target 2, 235. Buy one Condor, IBM, 21 March, 245, 42, 35, 32, at around 75. So I've been adding more description to the alerts so you understand a little bit more, but this is how it goes out with Thinkorswim. That's what it looks like. So then I say over here, so here it is on the 21st. Now IBM's trading around 242.24. So if you're long that 21 March put Condor, take profit today. Max profit today on a close between the spreads, currently up around 160 bucks, 228% return. So this was one that if you were in the trading room, this is one we've been following quite a bit. This was IBM. So I put these lists together and we constantly monitor it. So we got short right here, IBM, and then we were getting out here at our target. And so here's the trade setup that we put together. So we did a 245 put short the 242 put debit spread. And then we did the 235, 232 put credit spread. So we had this put Condor spread with $2.50 wide spread, right? Cost of the trade 70 bucks. That's our total risk. And then I'll show you my stop loss rules in the course. I'll show you how to set stop losses and all that kind of stuff. The course is very detailed. So potential on this trade is to make 180 bucks. On that risk though of 70, that's the most important thing, 70 bucks. So if we do make it, we get a 257% return. Typically we'll do a 60% stop loss, or I'll show you in the course how to use our fib levels and moving averages for stops, which is typically what I do. And then it went out right here. So this was pretty close to max profit. So the spread went from 70 bucks to 228, up 158 bucks, 225% return. So that was one. A put Condor, put Condor. And here's the SPY one I showed you earlier. I'll just flip through that. Showed you this one earlier. This was a great alert trade. Okay, and then what I didn't show you so far, these are counter diagonal trade alert service, part of the service. We do, you can see we've done more of these actually, but haven't been doing as many of these lately just because of the market condition, but we've done since June of 2019, 329 trades closed out, 238 winners, 20 break even, 71 losers, run about 78% win rate, unaudited. And so here's a couple that we recently have done. Here's one that we did recently. This was a put calendar diagonal. This was just in and out, actually. This trade was set up for maybe a longer term trade, but it ripped down so hard we went ahead and we were able to take profit that same day. So this was on the 21st. It was traded at 520 and it ripped, just look at that, just collapsed. So here it says new SPY short trading at 520, daily cycle high, retracement failure off 21, breaking Thursday's low, 4-hour negative momentum, downside momentum cross, target 1510. Know your risk before taking this trade. Buy this trade. Buy that the 25 April, 22 April, 519, 514. So I teach this. You know, if you want to understand counter diagonals, you can also buy the course off the website. Get a 60% discount. Plus, come in the room and ask me to explain any of this stuff. That's why the trade room is open as well. So got into this trade about $3.90, and then that day it just, look at that. So it went from 520, 509. This was that day a week ago. It's just insane. And so we just jumped on this first thing in the morning. It was trading right there. Just knew it was going to break, so jumped on this right on the open, right there, with this trade set up. And in at 394, just, you know, this trade went down from 394, collapsed down to 509.34. It was trading here. It was up 190 bucks. Okay, so that was one. And then here's another one that we did. This is on just one more to show you. This is on CCJ. We set this one up on the 21st. We've done so many different trades, but this is an example of a calendar diagonal at 53. Did an adjustment on the 22nd. So go through all the adjustments and then took the trade off on the 24th. This trade at 58 bucks. So here's a trade set up right here using the indicators. You can see kind of the momentum. Now I've got another full course on my indicators if you want to follow me directionally, but here's the entry right there, exit, adjustment, exit on CCJ and out, and here's the trade here. So went from $1.86 to 483, so up 297 per spread, 159% return. Okay, I hope that is clear on everything. No, if you have the indicators already, you don't have to buy them again. Just send us an email at support, and we'll update. We'll address whatever your issue. I'm not really sure if you could do that. That'd be appreciated. So here's everything again one more time. And you ask questions, please feel. Yeah, I'll show you that natural. We'll take a look at natural gas too. Let me just finish this real quick. And just one more time here. And sure, just want to say thanks again for everybody being here on this Saturday. I know you probably had a lot of other stuff you could have done, but I really feel fortunate that you're here. So Butterfly 15, and I'm looking so much also forward to the course and seeing you guys and gals in the trade room. So just one last summary here. You're going to get 2 months of my trading club for this course package 1. So today, use that promo code. It's 167. You get all these additional bonuses, and you get the discounted price today at 167. Now, if you want to add the indicators, you can do that. I'll go through it one more time. So that's course package 1. And then if you want the alerts added to it, you'll get everything in that course package 1, but you're going to get the alerts, all the different 5 that I would send out for the next 4 months, plus 5 months to the trading club. And so you'll get that today at 507. So 4 months to the alerts, all the different alerts that I might send, 5 months to the Q&As, video newsletter, virtual coaching room, discounts. Okay, so all that good stuff. And that's pretty much it. Now here's my new dog. He's Coco, and he's a pretty amazing. He's a chocolate lab, which I've never had. So that's my new boy. So he's my fifth Labrador I've had, and he's a super sweetheart. So to point that out, to make things end up, and then if you want to take one more look here at the payment link here, so just put in what you want, and if you do want the indicators, which I do recommend because it's what I've been using since 2010. I developed the indicators. It's what I use in my trading room, everything I do. So you can come down here and just add my indicators. Boom. And they're available for Thinkorswim, TradeStation, eSignal, TradingView, Thinkorswim. I think that's all, and Ninja Trader. And here's a quick look here at natural gas. Let's pull that up. This actually looks pretty good. This is one we were looking at in the trading room on Friday. This one we might go long, maybe Monday. I'll just use natural gas, the ETF. All right, so everything I look at looks pretty good here. We got positive momentum, cycle 1 and 2. We had a cycle reversal here. You can see that purple arrow. And we have momentum. We're having a momentum cross breaking the 21. This has potential to move up to this $20 level. That's the 50 simple. And here's the natural gas futures if you want to. I think you asked about that. Let me put those up real quick. All right, so here's natural gas futures. And again, thank you so much for everybody being here. And yeah, he's a handsome boy.